right, folks, good afternoon. My name is Scott Andrews, and welcome to today's webinar. Uh, I'll be speaking for the first half or so and sort of leading the discussion today. I'll also be supported by Matt here. Matt's our lead trainer and helps tremendously with research, and he also supports clients. He wears many hats, helps us with operations. Brian Casto, you may have received emails from him. Brian will be supporting as well. His job is make sure you're happy, and we can try to get solutions to that you need and to help you understand them. So we're delighted to have you today. We are going to take a little bit of a different angle. We support both discretionary and systematic traders. We've done it for more than a decade. Not many people can say that. The business, we've actually been around since 2008. Um, I'll get into my background in just a little bit, but we're delighted to have a good mix here of folks. This one's a little bit unique in that we're focused on helping people create strategies that can be automated. We can help in that process, though we can't do it all. We think we're filling a pretty unique niche or niche in doing so, and we'll be talking about that. First, the obligatory disclaimer. We are going to show, we're going to wrap things up actually at the end with a live example of a strategy that can be automated and traded, and we have strategies very similar to what we'll be showing you. So use this information at your own risk, of course. And as always, past performance may not be indicative of future results. In fact, it will. So agenda-wise, I thought we'd start off with just sort of stretching your thinking a little bit because we do things our own way. We've done it a long time. Our other co-founder, David Scourin, runs our technology. I don't think he's in the room today, but anyhow, we've been going at this for quite a while, and we've evolved over the years, and I'll be talking about that in just a moment. So I thought it'd be good just to give you an idea of how we approach trading, and a lot of this is really just my own approach, and talk about the strategies I've created and automated. And so my philosophy in hopes of sharing some nuggets with you, maybe stretch your thinking, and then talk specifically about where do you find edges, right? Sources of alpha, right? It's probably never been more competitive in the marketplace. Thankfully, the volatility gives us ample opportunity, and the markets are very liquid these days, which is just tremendous. So much better time than say 2017 was, right? So, but I'll talk about our approach to finding alpha. We think there's lots and lots of untapped alpha. That's part of the reason we're so willing to share. There's excess capacity in the market for the small lot traders, I guess. Certainly, we couldn't have all the big funds trading intraday, or it would really screw things up. So we'll be sharing our approach and some ideas on how you get alpha, help you discern sort of signal from noise, right? That's always the big question when you're finding an edge. Is this just some random good luck that you found a combination of factors or a filter that seems to have an edge, or is there something really here? I'll talk about that. And then t-test, just a simple, very simple statistic that you can use for trying to prioritize, select trades. We even use it to filter priority of trades when we run out of capacity, like risk capital that we'll want to trade in a given day. We'll sort and prioritize based upon a simple t-test. It's very effective for us. You can get more complicated, of course, but it's been a very effective tool that we've used over the years. And then I'm going to show you specifically, oh, our numbers are goofed up there, Matt. I have done that. Sorry about that. Bullet 3 there, we'll show you 3 ways to find edges using our platform. If you're interested, of course, you can take these concepts and code them yourself. If you guys have been around a while, I know we've got a lot of algorithmic traders. You know how to code, but we think we, again, could offer a pretty compelling value proposition. And we'll give you some ideas and options. And then Matt will take you through a strategy creation example. Just a simple one, but again, trying to connect all the dots. And we'll wrap it up with Q&A and hopefully be out of here in about an hour or so. As always, I welcome questions. If I don't answer your question immediately, I'll try to come back to it. If I miss it, I never skip a question. Just retype it again if you don't mind. Brian might help out answering some of these questions as well. All right. So what you see here is probably very difficult to read, and I apologize for that, but it sort of makes the point as well. This is a list of the automated strategies that we trade for our own accounts and client accounts. We do have a service, and we've helped manage capital for a while. Actually, we've been a CTA for the past few years. We are no longer a registered CTA, so disclosure there, but just a little quick background of sort of how we came to have so many different strategies and why. I started off as a discretionary trader, came out of the corporate world 15 years ago, quickly moved away from charts and got very interested based upon my interest in math and statistics in trading around edges that I could quantify. It just made a lot more sense to me. So I hired my good buddy and close friend and original technologist of the first company we created, David, to code my ideas and help me do testing and research. And we created a handful of strategies that we traded with great success, frankly, manually. So we'd have a system generate a signal, and then I would execute that signal manually. And there might even be people in this room right now, I don't know, that were with me back in 2008. I know I see some names that have been with us since 2010, but back then I would have a signal, and I would actually share that signal with the clients before I would actually enter the trade, and then I would manually execute the trade. So way of often described as hybrid trading right now. That's what Brett Steenbarger, a friend of ours, and great guy. And, if you don't know him, you should check him out in his blog, Trading Psychologist, and a good trader as well. That's what he calls it, hybrid trading. Very effective for us as we grew, though, over time, and we had a lot of success in the financial crisis back then. Um, we evolved to having more and more ideas and seeing things that weren't considered in our strategies, and we simply couldn't put them all into the systems and trade them manually. It was just too much. So we evolved quickly to, actually it wasn't quickly, over a couple of years, to going fully automated so we could capture all of our ideas. And we still focused on, and so we could focus on supporting our clients, something we wanted to do. Um, but over time, the ideas kept coming and edges kept coming, and we couldn't incorporate them and take advantage of them any other way other than um, in an automated fashion. And what we came to realize also was that what we thought our best strategies were in a given, going to be in a given year, rarely were. In fact, what worked last year often didn't work the next year, but then worked for the next 2 years, and then would skip a year. And no matter how hard we tried, and I did spend a lot of time, we spent a lot of time trying to perfect just a few of our best strategies. Some of you may remember Pearl, those original, Otis and Pearl, the original strategies, names of my original strategies. And if I had to do it all over again, I can tell you without a doubt, I would have spent way less time trying to perfect um, those few strategies. Instead, I've done what I've done over the past, what we've done over the past 3 or 4 years, which is to simply automate as many edges as we can find and focus on a portfolio of edges there. There just aren't enough good edges that stand the test of time that you can just go all in on. So um, I forgot to include a slide. I mentioned in the email marketing of what we're going to do today, the um, why the advent of micro futures might be the best thing that could happen to us systematic traders in years, maybe ever. And I'll just cover it right here real quickly. That's because now we can create portfolios and control our risk way better trading futures. You can trade 1/10 of the risk, which makes it much easier to use less of your trading capital, right, your risk capital, um, and you can trade many more strategies. So it's a perfect time for the discussion we're having today. And the micro futures, I believe that's only going to grow they're only going to grow in terms of liquidity and availability for everyone. So um, we've evolved. We have many, many different strategies organized by a few different portfolios. And what's really interesting, if you could dig in and expand the slide, I'm not sure what level of detail you can see. They haven't all made money by any means. Some have been tremendous, some have not. But overall, we've done pretty well. The um, key thing you might note, though, is that they don't trade very frequently. We're only trading an average, a typical strategy, one time per month. I know that's just crazy talk for some of you. Some of you can't imagine that. Some of you are probably more of the high frequency type, and that's fine. I'm not at all saying that you have to do it our way, but I'm trying to stretch your thinking in terms of um, the opportunity that's there to diversify your approach to trading with today's technology and with tools like we offer that make it really easy to find what I would call peripheral edges. Um, Edges that maybe they don't trade as frequently enough to attract the attention of bigger money perhaps, or to even small lot traders, but they still exist. And you can look back over 10, 15, 20 years, and something has stood that test of time. And there are lots of them that trade infrequently, but have done consistently well through most market conditions or very specific ones. That creates an opportunity to automate an edge. So, a lot of I already see some good questions coming in. Let me power through, and I'll get to some of those questions. So here's an example of one. This will partly answer your question, Jason. Jason's asking if your strategies only trade once per month. How often? They uh, Often they can run for years before failing. How do you know you actually have a statistical edge without enough prior examples? Great question. That's the big quandary for us all. And I'm going to talk about that. I've developed some techniques that help me interpret the data that's been very helpful and very effective. So here's an example of one that I almost didn't put in, but it was recent and real, and it was yesterday. A lot of change. That traded. This will help answer your question. So this strategy triggered yesterday was actually a short, right? Tough market to short. So it hasn't had many short opportunities that that met our criteria, but it trades an anomaly of the VIX. And I'll just leave it at that. So rarely trades. You can see this particular scenario, which is trading the VIX, and this particular one is trading only large down gaps. And it's a follow, so it's a short. It's only triggered 34 times, and I built this 3.5 years ago. So it maybe only had 20 or 25 trades, and I know that's making some of your heads explode, right? Like, oh my gosh, that's crazy talk. Well, let me back up. The anomaly that it trades works for just about all opening areas. So the sample size that I found the edge on was much bigger, a couple hundred trades, maybe more than that actually, in terms of its frequency. And what I've done is I've taken that core concept and applied it to different opening scenarios. You'll hear more about that in just a moment. That's really been the key for us and for me for finding unique edges that maybe on the surface don't even look great, right? Like this one. But if you looked at all of them together for all the different opening areas, the curve of all of them and the sample size far bigger and far more attractive. I don't believe in cherry picking and only trading the equity curves that look great. If I understand the edge, I think there's some causative link, then I will trade it and I'll be very disciplined and stick with it. So after we launched in 2017, we had a couple of big losses there, and this had several big wins since then, including a big one yesterday where it went short and held all day. So that was just one. We traded five strategies. Actually, four triggered because we ran out of risk capital in the account that was in, but five triggered, all short, and this was just one of them. The others were based on completely different concepts. So hopefully that addresses a little bit more. The idea here is that I believe there's lots of opportunities that you can identify around core statistical edges that you can then refine and make very specific and add context that you can leverage and create lots of portfolios of them. It's never been easier to do that. So like here's an example of just a portfolio of our ES strategies, just trading those. I believe we've got portfolios that diversify across multiple markets. They have their strengths and weaknesses as well. But for example, there's 26 different ES strategies in this one portfolio. I just showed you one of them. Some of them trade 50 times a year or more. So sometimes it is hard to answer your question directly to know if a strategy is no longer working or not. But I'm going to get to exactly why, because I've got my 3Cs rule. And if it passes my 3Cs, then I feel a lot better about trading something that doesn't trade very frequently. I mean, I will say, even though I'm not trading, when we were CTA, just to get a little bit of credibility, I don't know, I do recognize a number of names here, but for people that don't know me and know us, we have done this a long time. And as a CTA, I'm really proud of the fact that we managed capital and traded capital for some really well-known, high-quality firms and traders, including, you may have heard of Peter Borsch. He was Paul Tudor Jones' right-hand man, if you watched the movie a long time ago about Paul Tudor Jones. He was in charge of systematic trading, quantitative research, Peter Borsch. So we passed his sniff test, and I'm very proud of that in terms of the robustness of our approach. We learned a few things from him too, which was great. Today, though we're no longer a CTA, we do create and manage strategies not only for clients, but also we do signals for some firms as well. and that manage firm capital and their own capital as well. And some like S&B Capital, you may have heard of, world famous prop shop right there in New York City. So what we do works. It's not for everyone. That's why I'm just trying to share some ideas, stretch your thinking. All right. So where do we find these sources of alpha? Um, as we think about it, it's an event that is the catalyst, right? That's what creates the market movement or the opportunity. And there's different types of events. And I use the word event loosely. It could be a non-technical event, like an economic report, uh, any number of them that occur at 8:30 or 10 Eastern time, what have you. Crude oil reports a great one, right? That causes all kinds of markets to move, non-farm payrolls and so on, right? Calendar, seasonal considerations, earnings periods, first day of the month, last day of the month. Market events like FOMC announcement day or even the release of the minutes can sometimes cause the markets to move. Um, there are also technical considerations, right? Price-based considerations, and that's how I got started originally. Was looking at unique price configurations where price was opening in the context of a certain market scenario, being overbought or oversold. You could predict with some degree of accuracy the odds of getting a mean reversion or a follow day, and control your risk, and you can catch some really nice trades that way. So anything in that category or those categories I just described, we consider to be a market event. It can be price, like technically based, or non-technical. That provides the juice, the heat, the reason for movement in the market. When you combine that with an analysis around the unique opening area or a unique intraday technical level break, like a break of a 60-minute range or a key pivot level or Fibonacci level, combination of the market setup with a unique opening area or triggering price action and around a catalyst event can cause some tradable, repeatable patterns. So that's the way we have found lots and lots of edges. In fact, it's more than people ever believe. But we have mined our own factor database. We have close to 1,000 different factors. We break them down as price events, calendar events, economic events broadly. Matt will show you specifically some different libraries, so we get more granular than that. And just looking at some of the most liquid markets, S&P, NASDAQ, crude, gold, 30-year bonds, there are literally hundreds of them that pass statistical significant tests. T-scores of greater than 2, which is 2 standard deviations, for example. Now, some of that is just noise, right? And it may be absolutely no relationship whatsoever, and that's where it gets tricky, right? So how do you discern between those? But again, there are hundreds of events that could be used as foundational edges or combined to create um, quantified strategies that you can automate if you want or trade as a rule-based trader on a discretionary basis. So here's how we think about signal versus noise, because literally there are so many edges we find every day. We're asking ourselves, okay, what's the deal with this scenario here? Is there something real? Is it just randomness? First, let me say it absolutely can be randomness and often is some random correlation. If you look, there are lots of studies on this um, and lots of white papers. You ought to educate yourself. There's more randomness and more noise than there are real signals in the marketplace, right? Um, and even just because you find an edge that it passes some statistical significance doesn't mean that's necessarily um, an edge, right? It could just be random. It may just fall apart. You just happen to find something that worked for the past 5, 10, 15 years. So the 3 C's rule that I use just very quickly is I ask myself, is it causative? Is there some causative linkage? Causation is really hard to prove and know. Um, so I use a sort of broad assessment in my mind, but I want to understand the logic, right? And Matt's going to show you one around a 50-day high and a breakaway gap, perhaps. And there is causative reasoning. There's an understanding of the logic of human behavior and trader behavior on why what he's going to show you works. So and I'll talk about that maybe if we get there, if there's any questions. But you want to know that there's some logic that you can get your head around that makes sense. I then want to make sure that there's context. I don't believe there's many things that work without context in the markets. The volatile market, high vol, low vol, trending market to the upside or the downside? Are we in a chop environment? And so on. Um, and I need to be able to explain that context as it relates to what I think is the logic for the signal, why it works. Why it works. And then, most importantly, because those are objective considerations, I need some type of analytical, empirical analysis that supports my strategy to really feel good about it. That's simple. I can test the exact same edge on a sister market, right? A highly correlated market ought to give comparable results, at least something positive. I would not expect to see um, a strategy that works on the ES not work on the YM at all, at least broadly speaking. Different stops and targets required, maybe, but certainly the broad edge needs to stand up. So that's what I mean by confirmation. If you don't have a system market and you're trading, this is a common question I get. You don't have a system market for the market that you're trading, then the best thing to do, and I found it works well, is to simply look at a sister time frame. So let's say you're trying to trade a 15-minute range breakout. Well, that edge ought to show up on a 30-minute range breakout, right? So that's what I mean by confirmation. Any questions there at all? Please feel free to fire away. And I will move on. So even using the 3Cs rule, you can still end up with too many things or too many strategies triggering, too many edges. You're not sure which ones to trade or how to prioritize. So the t-test is designed, like most statistics, for perfectly normal distributions, right? So I'm well aware that it's easy to pick these concepts apart, but we have to work with the best we can put our hands on. And for me, for simplicity, right, the t-test is the tops, because it's very simple. If you look here in the left box, right, it's just simply the average trade, right, the mean of all the trades, um, multiplied by the square root of the total number of trades, divided by the standard deviation of those trades. So if you're not a math person, stat person, don't worry too much about it. But it's because it's simple enough. You can pull this number out on most platforms and calculate it even in Excel easy enough. And then the larger that number, the more confidence it should give you. So if there's a perfectly normal distribution and you tested something for the first time and it gave you a t-score of 2, then you should have 95% confidence that you didn't find something that was just simply random. The more you test, however, you look at lots and lots of tests, then the greater the chance that you are finding something random. So you want to always shoot for the highest number you can find. But I do love it because it includes, again, average trade, which is just expectancy, right? The average result of all the trades in the sample size. It also considers the size of the number of your trades. So obviously, the larger the sample size, the greater your t-score is going to be, and the greater the variability in the results, the standard deviation, the lower it's going to be. So it really does a nice job of pulling all those pieces together, and a lot of folks use it. A lot of professionals that I know, and a lot of our clients use it as well. And it's just a nice, simple filter. So hopefully that's helpful for you. Yeah, I didn't mention another question. Have you determined how long your signals are valid for? The bias lasts for minutes, hours, or days. Everything I do, I'm an intraday only trader, or primarily trader, almost exclusively intraday. I want the edge to last for the bulk of the day. So I tend to start and focus on edges that go from open to close. Really hard to find. Um, but there are certainly plenty out there. In fact, those statistics I just showed you from the number of edges in our database are from open to close. Simply looking at a directional bias from open to close, 9:30 a.m. Eastern Time to 4:15. And then I'll trade derivatives based upon entering at different times of the day, because most of the time they'll hold up. And if you wait too long, you may miss almost all the gains if you wait till the middle of the day. But you can often use range trades. You can also exit early as well. So our typical trades and strategies I trade, they're all over the map. If I'm doing a mean reversion strategy that's going for gap fill, it may average a 1 hour um, length in time, 1 hour hold. But I would say overall, our typical strategies last 2.5, 3 hours. That number's gone up for me over the years. It used to be more around 1.5 hours. I've close to doubled it now because I'm holding many more trades for till the end of the day or I'm following them because I'm following the gap and trying to capture trend days. So yesterday the technique was a hold all day. Today actually, I didn't mention it, but there was a sister derivative of that same VIX anomaly trade that we traded that triggered to the long side, and also, actually I take it back, that did not hold all day. So I missed out on some gains there. Um, had a technical target. But again, it's the same edge you can use for different targets and different holding periods. Yes, Ernest asks, are you typically in and out during the same day? Always. I'm an individual trader. I don't need to take the risk of futures overnight. When you approach these statistical edges like we're talking about that occur around events and around unique opening areas or unique price action, you can set up trades and capture with futures and use the leverage of futures to make as much money or risk as much as you want, basically. And with micro futures now, you can create lots of strategies, many more, and spread your capital even further in a more diversified manner. And that's where the magic is. I mean, if there's diversification is key for investors, well, you know, intraday trading is it's the same. Diversification is still king. All right, so real quickly before I turn it over to Matt, I want to cover just at a high level what he's going to show you in terms of demonstrating how we go about finding sources of edges. The three ways in our platform, we call it the Discover platform. We built it out of frustration, frankly, because I'm not a coder. I'm an easy language hack using TradeStation over the years, for many years, more than a decade, and I love TradeStation. It's been fine for someone like me who has a real math inclination and has some programming skills and capabilities, but not much. Um, but it just took too long to test simple ideas. And I realized I was spending so much time testing, and it also sort of led me down this path of over optimizing stops and targets because it's so easy to do that inside of really robust platforms. And I've realized over the years the most important thing for a strategy is the foundational edge that it's built upon. I don't need to have to optimize stops and targets to find edges. So I wanted a platform that we could test ideas, I could test ideas specifically without having to send them to David or one of our other developers to test it and come back to me the next day or 2 days or sometimes longer. And then I would have to get information back and save it and track it and so on. So we built Discover for ourselves several years ago to make it easy to test ideas, make it easy to find edges, and make it easy to refine and modify those edges and track them in sample and out of sample without having to ever code. That's what Discover is all about. That's why it's useful for discretionary traders, um, but probably even more useful for automated traders because it's all about trading the strongest edge you can. Like the foundation of your house has got to be strong or it's going to crumble. So the stronger the edge or edges that you combine, which I'm a big believer in taking multiple statistical edges and combining them, that's where the money is, in my opinion. So real quickly, um, first and foremost, this is just a screenshot just to allow me to summarize and familiarize you with Discover a little bit. You can go into the platform and test your own ideas. It's a completely interactive point and click platform, as you will see, where you can go into different libraries of factors and select either an equal mark or a minus mark to include or exclude a given factor. And so you can combine multiple factors and create and find edges in minutes in what typically would take hours to probably program even a really good programmer. And we hear that all the time. So it's a really, really valuable tool in that regard. That's the way a lot of our clients use the platform because they've got more ideas than they have time to test otherwise. So they'll go in and they will test them using our platform instead of programming them. The second way to do it is to use our bias library. We have created and continue to create and evolve a library of statistical edges. They're not the very best in the platform by any means, um, uh, but many of them are very good, and they're really meant to just be building blocks, foundational um, statistical edges that are statistically significant or noteworthy, and we put them into what we call a library of about 150 of them. About half of them are across the indices, and the other half are spread across different commodities like crude oil, gold, and so on. But they are in the platform that you can scan and review, evaluate, check out the equity curve, historical performance, and decide if you want to explore it and build upon it further um, using the platform or with your own coding. And then the third way uh, to leverage our platform is to actually mine the data in the database. We have an application that we have built that sits on top of or underneath, however you want to think about the Discover platform, um, called SSE. That stands for Statistically Significant Edges. Uh, and it allows you to go in and search for the best individual shorts, longs, fades, or follows. A follow is just going with the gap as we think about it intraday across 15 to 20 different futures markets. We do have ETFs as well. I don't know if we have the ETFs loaded in SSE. We just added ETFs to the Discover platform. We have the four primary index ETFs, NASDAQ, S&P, Dow, and Russell. And we have the select sector ETFs as well. Those 9 sector components like trading oil and so on. So you can use the SSE database app to go in and search individual libraries, individual categories. Um, you can add your performance criteria, uh, trade um, size, I guess frequency, if that's the way to say it, the sample size you want to test. Is there a total net profit you're looking for? This is based upon one contract, a minimum win rate, profit factor, average trade, and so on. So very efficient way. It's a very sophisticated app. We actually have a couple versions of it. There's a retail version, which is what we'll be showing you today. And there's more advanced features for any of you that may work for a firm or want a more of a commercial grade app to download or work with an API and so on. And lastly, after you find an edge, so you mine the data. The database is almost 2 million total um, factor combinations in the database right now. And Matt will which means it's a little more than 100. I think it's about 135,000 any individual one right now. Once you find an edge you want to build upon or combine, you can then go into the platform, start combining them and prototyping. And it's such a much more efficient way to accelerate your development process because you can test a bunch of ideas literally in sitting down an hour. You can probably do more in an hour than 8 or 10 hours programming. And we've heard that from many people. So Matt will be showing you that as well. So before I turn it over to Matt, any questions for me? We're about a little more than halfway mark. Rick says there's a way to do walk forward optimizations, not with the platform as it's currently configured. Forward optimizations, not with the platform as it's currently configured. We're just at the tip of the iceberg of where we're going, Rick. We do make it very easy to monitor. We're not big enough. The platform in general is not big into optimizations. If you want to do optimizations, I think you could be better off with one of the many commercial apps out there for doing that. What we're all about is edge discovery. We think that's sort of the missing link for most traders. There are way too many strategies, too many hours, too much money, time, and wasted spent on creating strategies, optimizing targets and stops, and they're built on weak edges. And that's because it's so hard to test and code all the many different scenarios. So that's why we built the platform here. Pete says, discover, find overnight edges. Not currently. That is on the radar and on the drawing board to be added. As you know, we've got our legacy. We do have a legacy service for overnight trading and swing trading, and we will be incorporating them over time. Overnight would be next, and we don't have any timeline right now on swing. We've really been mostly focused on intraday over the years. Question, is there an API to allow for custom development? We do have an API that we can feed you different factors and that you can find and source and get updated when they're in play or not. So we'll give you an opportunity to complete a survey. Actually, you should have a survey in your inbox when this webinar is over. And one of the questions is, how do you want us to follow up, and do you have any questions? So that's a great place for you to answer and tell us more about exactly what you're looking for, and we can have a follow-up conversation from there. Steve, yeah, actually, I have heard of LIM. I think actually LIM was 10 or 15 years ago. Someone purchased it for a pretty penny, actually. But yes, You can do similar queries there, and that's been purchased by a third party now. Pete says you still have wacky names for each edge. Well, those are really strategies. Pete, we do like to name our strategies and make it fun. Life is short. For edges themselves, no, they're pretty boring. Matt's in charge of naming, naming, so you can blame him. But I think I've gone over here on my allotted time, so let me turn it over to Matt. Matt, it's all yours.
Alrighty, let me get my screen going. You should be able to see my screen now. I am showing the actual Discover platform here. So let me give you just a quick overview of it, and then I'll show you some of the stuff that Scott was just talking about. So we've got a couple different buttons up here in the menu bar. We've got Analyze, which is more of a discretionary tool to find ideas on a daily basis. We won't really get into that today, but that is a feature we have. Discover is what we're really going to get into, so let me go ahead and click on that. Discover is where all of the testing takes place within the platform. And the way that Discover is laid out, you've got your header section up top, which will show you anything that you're testing whenever you add a query or a factor or something to test. It will show up here in the header section, so you'll know what you're looking at. And then we've laid out our different libraries on the left-hand side pretty logically to where you can kind of just walk your way down the different libraries, build out your idea, hit view results when you're done, and you'll have the results of whatever it is you're looking at pretty much instantly. So starting from the top here real quick, symbols and settings, this is where you would pick out your instruments. You've got your different asset groups you can start with. So if you start with the indices, you can select between the ES, the NASDAQ, YM, or Russell, and you can select multiple instruments at the same time. Then you select your setup, your trade type. You can do a custom date range if you want to, slippage and commission, all that kind of stuff as well. Below that, you can select your stop and target. You've got end of day is something that I use often when just kind of prototyping an idea. But then once I'm ready to really drill into it, I'll add a stop and target. And I typically use the ATR-based stops and targets because they adjust the volatility. But we also have dollar-based stops and targets as well based on trading a single contract of whatever it is you're looking at. So we do have that option available as well. I'm typically using the ATR though because that tends to adjust to volatility. Below that, we have our opening filters library. And this section is huge. This is where you can really drill into where the market is opening relative to yesterday's range, yesterday's close, recent highs and lows. This is a really, really helpful area, and it's been a big source of edge in many of the strategies that we use is just by focusing in on where we're opening at in combination with some of the other factors. So you can select pretty much any opening combination you can think of where the market is opening at. Under that, we've got price patterns. We've got 8 different categories in here. I'm not sure exactly how many factors we have, but these are all full of different factors, and you can build out about any type of price action that you would think of using these 8 different categories within the price patterns section of Discover. And to look at anything in here, all you gotta do is hit the equals button to add it. You can see it goes up here in the header section, or if you want to exclude it, you can hit the minus button next to it, and that'll look at anything except what you've excluded. So I just excluded a higher close. Let me get rid of that though. And it's all just point and click, so really simple stuff. And we even tell you what is true for the current day over on the far right-hand side. Underneath that, we've got profile patterns. So these are market profile patterns. This is the only platform I am aware of that allows you to backtest market profile concepts. So that was pretty exciting for us to get this added to it, and it works the same. It's very simple, just point and click to test any of these types of ideas based off of market profile. We've got a bunch of indicators. This is where you can find things like moving averages, volatility type things like ATRs, all kinds of good stuff there. Underneath that, we've got a section for volatility to where you can customize volatility regimes. Just look at specific user inputted metrics for like what is the ATR, how big is the ATR. You can put in minimum maximum levels to kind of isolate different volatility regimes, as well as VIX as like a one-day moving average of the VIX, which is just yesterday's closing price of the VIX. But you could put in, the VIX is less than 13 if you just want to zone in on what's happened historically in a low volatility environment. Underneath that, we've got calendar section, and this is where you can do all your seasonality stuff. We've got about anything you can think of in here. And then lastly, the market events section. This is where you can find all of the higher tiered market reports for the days that the report comes out, as well as things like options expiration day. There's some futures expiration in there. There's all kinds of creative things in here. I think we've got about 25 different reports that are available that you can test. You can test the day before, the day of, and the day after. So there's all kinds of different variations of things that you've probably not been able to test yet. But this is kind of a layout of what the Discover platform looks like, and this is where you would come to start your test. Now let me go into the strategy section. I've got different tabs open here because that's how I prefer to use the platform. This is the strategy section, and the strategy section is where you can save all of your work when you create a strategy. You can build out anything you want, hit a save button, and it'll save it into the My Strategy section right here. This is for all your personal strategies, but what we were talking about earlier was the bias library. And the bias library is preloaded with biases that are either statistically significant or noteworthy that we've put in here for you to use as starting points. You can build strategies off of them. Some of them are quite strong, and some of them are ones that you'll just want to be aware of and maybe not trade against, that sort of thing. But the way this works, you've got a little plus button here, which if you click, it will expand the details. It'll tell you the rules that are included. So this top option here, long bias, volatility, compression. I've got a little tooltip here that I can click on to get a description of it. This one says, if opening above the prior session high and the one-day ATR is less than the 5-day ATR, historical odds have favored closing higher than the open by 4:15 p.m. Eastern Time. So this is based upon getting long at the open when you open above the prior day high after this volatility compression pattern. If you look on the right, you can see the equity curve that pointing up here to the upper right. You've got some quick view stats right next to it where you can see sample sizes, win rates, profit factors. And in fact, if I click on this new button we just added today, actually, a lot of our members haven't even seen this yet, but you can quickly load the stats right here from this page, and you can see more details about the stats. You get the equity curve. You've got the stats here for the entire look-back period right to the right. Underneath it, you've got look-back periods broken down by quarter, 6 months last year, 5 years, 10 years, and since the beginning. You've also got the monthly results and the last 10 trades. So this is all functionality that we just got added to it, which will quickly allow you to look at some of these biases. And whenever you want to really dig into it and start building a strategy off of it or something, you've got a button over here which will actually load it into Discover, and then you can start building upon it. So we've got what looks like 149 different ones in here, and as Scott said, they go across all kinds of different asset groups. You can see we've got energies, indices, metals, interest rates. We've got some different instruments as well, and setups, all kinds of good stuff here. Oops, I just hit my reload button on my mouse. So let me go back to that, and you can sort through these however you need to find whatever it is you're looking at. Let me just pick one here from the end, which was one I was going to use as an example to show you. This one here, long bias, 50-day high close. And we're going to dig into this one a little bit and just show you how you can quickly take this and turn this into an idea that maybe you could begin trading. So I'm going to click this View Strategy Backtest and Discover button, and it'll load this bias into Discover where I can start working off of it. You can see the rules right here. Let me go ahead and hit this icon so you can read about it first. It says if opening below the prior session close, so that means it's gapping down, following an unfilled up gap that closed at the highest closing price of the past 50 sessions. So that means you've got an unfilled up gap that closed really strong. Historical odds have favored closing higher than the open by 415. So this is showing a long bias when you gap down after an unfilled up gap that closed at a 50-day high. Let me go ahead and click on the view results, and we'll be able to see these results right below in more details. And here we go. So this loads it into Discover. Again, it's the same rules that I just mentioned, where you're gapping down after an unfilled up gap after a 50-day high close. So you got a really strong market, potential sign of potential exhaustion or something, because you're getting that unfilled up gap the day before. So it's breaking away and closing at a high. It could be pretty stretched up there. But this is saying gapping down after that has had a historical tendency to move higher. So what we can do here is we can come into symbols and settings and change this up a little bit to turn this into something that might be a little bit more tradable, since this is just an end of day bias based upon entering long at the open of regular trading hours, which is 9:30 a.m. Eastern time, and it's got an end of day stop and end of day target set for it, which means it's getting out at the close of regular trading hours. So this is kind of just a daily bias, which is what most of these are. And what we can do, since we know that's a long bias when gapping down, we can go into symbols and settings, and we can change it into a gap fade. So if I go into trade type here, instead of just going long, we can hit fade, and this will give us the option within our exit criteria to get out at the prior day closing price. So that becomes a target for the trade. Let me just hit view results here. You can see how quickly this will run. And I kept the stop there end of day just to look at this real quickly with the stop at end of day and targeting prior close. And you can see the bias still pretty much the same, pretty strong, extremely strong win rate for this setup when targeting gap fill, but this is using an end of day stop, which is not really realistic for most people, myself included. But since I see that this is still holding up well as a gap fill trade, this tells me we can dig in a little bit deeper, and I can look at maybe adding a stop to it. So let me just throw a stop on here. And then I want to also go into the opening filters and say that the gap size has to be a minimum amount. So we've got a lot of different ways that you can do that. I'm going to use the gap size percent of a 5-day ATR and type in 5. So this means that the gap has to be at least 5% of the 5-day ATR. And this is just going to get rid of those gaps, which may only be a few ticks, and they'll show up as winners, but they don't really amount to anything, and they're not worth taking the risk on. So I want to get rid of those and make sure that there's at least a little something there on the gap trade for me to consider taking it. So let me add that, hit view results real quick, look at it again, and still looking pretty strong. We've got 116 samples, 76% win rate, and this is using a 60% stop. So when we didn't have a stop on it and we didn't have the minimum gap size, it was about 84. So the 60% stop is pretty much capturing all of those. Stats look pretty good. Let me go ahead and just add a tighter stop there, because that 60% really didn't make much of a difference whatsoever. So let me tighten this up to 30% of the 5-day ATR, and that'll give us a little bit tighter stop. ATR is just average true range for those of you who aren't familiar with that. That's just kind of a way of measuring recent volatility. We use the 5-day ATR in the platform most frequently. So now with the 30% of the 5-day ATR, again, win rate not really going down much. Stats still looking really good. Nice profit factor there. Got 116 trades and really strong T-score. Drawdown, not much compared to the net profit. Average win, not quite as big as the average loss, so that is not typically ideal, but it's got such a high win rate, it can withstand that. So what I want to do now is, seeing how this looks pretty good as it is, I want to just eliminate one thing that I know is often a risk factor for gap fades. And I know that because I've been able to look at a lot of these over the past year or so as I've as I've been able to dig into some of these strategies. So let me see if I've got this open. Yeah, right here. What I want to show you real quick is fading gaps. Your little educational nugget here. Fading gaps, 30% stop, targeting gap fill on Mondays. So let me just show you this by itself. This is going to fade any gap on Monday, 30% stop, targeting prior close. And you can see that has been a really, really weak bias. So that is not something really weak bias. So that is not something that I want to be trading on a Monday as a gap fade with a 30% stop and targeting gap fill on most days. So what I can do is go back into the strategy we were looking at, and we can see what happens if we exclude those Mondays, knowing that that bias is not favorable. If I come in here, hit minus on Mondays, we can get rid of the Mondays, or we can hit equals to just look at the Mondays on this setup. So let's start with just the Mondays to see if they're similar to the overall bias. And you can see they are fairly weak as a whole. You can see the win rate's lower than the overall win rate, and it's lost money pretty consistently. So this is kind of a risky day to be taking that trade. So what I can do is exclude that day from my test by hitting minus, hit view results, and look at it again. It does get rid of a handful of samples, but it was a handful of samples that was on a risky day that did not amount to any profits. So it makes it look stronger and avoids taking a known risky day. So that looks pretty good. Now we can use Scott's rule of looking for confirmation on the idea. So what I would do, come into symbols and settings, add those other 3 instruments to it, hit view results, and we'll look at running this test on all 4 instruments at the same time as going long on a down gap of at least 5% after an unfilled up gap that was also a 50-day high close when it's not Monday. And when you do that, it looks like we've got some confirmation coming in here. We've got the NASDAQ, which is this orange colored equity curve. The stats here for the NASDAQ, pretty similar sample sizes, about a 70% win rate, average trade, about 50, profit factor, decent, T-score, favored, not quite as strong though. YM looks pretty strong, or pretty similar, I should say, not as strong as ES, and Russell, not as strong, but not bad either. So what we're seeing is 2 of the 3 instruments are generally similar, and that's kind of all you can look for. You can't assume that they're all going to be the exact same. There's always going to be one that's a little bit stronger, one that's a little bit weaker, but generally they are in agreement. This has been fairly favorable historically for all of them, so I like that. Now what I want to do lastly, just get rid of those, go back to the ES, and just see how it holds up with a slippage and commission in there. So I'm just going to put 20 bucks in here per round turn. So that's for an in and out trade. And that looks pretty good with a $20 slippage and commission included on each round turn. So from here, I'm just going to save it. And this could be something you could think about automating. Let me hit this save strategy right here. That'll give me the option to save this. And we will call this gap fade after 50-day high. And I'm not going to fill out a description or notes while we're here, but I have those options, and I'm just going to click this button here at the bottom to enable alerting for this strategy, so I can actually be told on my alert section when it is triggering moving forward. That way I don't miss out on it. All right, so let me see. We are 5:30. I am going to go straight to SSE now and wrap this up showing you this cool tool called the SSE, which is a statistically significant edges database. What this is the ability, it gives you the ability to scan through all of our 2-factor combinations and find just the best stuff. So the way it's laid out, you pick your instrument on the left. I've got ES selected here. I'm going to go ahead and just hit this button which will hide that to give me a little bit more screen space. And you can see we've got trade types, which you can actually click on. You can pick, do I want to look at something long, short, fade, follow? So there's a couple different or 4 different trade types that you can actually look at. There's all kinds of different opening filters. You can click on here and see there's about 25 different opening filters, and this will allow you to sort through 2-factor combinations of an opening filter and then a secondary factor, which could have came from any of those options that I showed you just momentarily ago through all of our different libraries. So you can combine 2 things at a time, and then you can sort by trade count, net profit, win percent, average trade, profit factor, T-score. In fact, if you come over to this columns, you can look at a bunch of different look back periods as well. So any of these on like a 5-year look back or a 10-year look back, you can add all that kind of stuff here as well. And if you click on this, it's going to add it over here to the right. If I go down to the bottom, you can actually see how many are in here. So we've got over 135 combinations available just for the ES that we're looking at right now. So there are 135,728 different 2-combo factor combinations that you can sort from. So let me just run a sort here and show you how this works real quickly. You can select anything you want, but I'm just going to, for example, pick short. And then I'll just type in a minimum trade count, and we'll put in 50 there. Hit enter, and this is going to get rid of anything with a really small sample size or anything less than 50. And then I can just go, we'll do win rate, or win percentage. We'll type in 50% and hit enter. And now we're only going to be able to see stuff based off of things that have 50 trade counts, so 50 samples in there, and at least a 50% win rate. And now once I've done that, I can actually click on any of these headers and it'll sort. So that just sorted from largest to smallest. If I click on it again, it's going to sort it from the smallest to the largest. And what it's telling you is, the trade type short, open above the high from 2 days ago. So this is the opening filter. It's being combined with something from our profile pattern. So this is the market profile pattern within the profiles library. It comes from the POC placement box that is in there, and the actual factor is POC finished in the bottom 25% of the daily range. So this top row right here is telling you short, when you go short at the open, when opening above the high from 2 days ago, when the POC finished in the bottom 25% of the range, that has happened 51 times. Historically, it's got a 58.8% win rate. Average trade on those, $93 per contract. Profit factor 1.88, T-score 1.73, and you can see profit last 5 years, average trade last 5 years, and you can actually click on this button here to load this test into Discover. But this allows you to put in anything that you can think of here for minimum win rate, minimum profit factor, minimum T-score. If you just wanted to look for the highest T-scores, you can sort by that. You can put in 1.6, which was the metric that Scott talked about earlier of being statistically significant. You can put that in and just sort for the ones that are statistically significant by that measure, and come up with all kinds of great ideas that you can examine. We've got a bunch of them here. And let me just click on this view results so you can see what it looks like. If I just click that button right here, that loads it into Discover. So this tells you all the same stats that we just looked at: 51 trades, your net profit 47.50, the win rate 58.8%, all of that same stuff available right here. And then of course, once you're in here, you can massage this anyway. You can dig into it and save it as a strategy if it's something you want to save, or put stops and targets, all that kind of stuff. But the SSE database is there to allow you to sort through all of our different factors to find just the best stuff that you might want to build automated strategies off of, or rules-based strategies. It's going to allow you to just find the best stuff in an instant. And it's just a matter of putting in a minimum criteria that you want it to meet, and then hitting enter, the cream's going to rise to the top, and you can quickly fly through the ones that look interesting to you. So that is pretty much a quick overview of what this SSE database is. Let me go ahead and pass this back to Scott, as we're getting a little bit long here, and we can take questions and start to finish up.
All right, thank you very much. Matt, yeah, my apologies. I was the one that went a little bit long-winded there. You did a great job, covered a lot of ground for folks. There were some questions. I answered a few of them in the text boxes. Just to be clear, though, when we talk about opening of the futures, we know futures trade almost 24 hours a day, right? We're talking about the regular trading hours. So we're using 9:30 a.m. Eastern time, and we're using the regular trading hours close of 4:15 p.m. Eastern time. So that's what those assumptions were for entering at the open. No, we do not have the ability to show percent of profit relative to your trading capital at this time, but it's a great idea. Let me just wrap things up. I'll get to other questions at the end. So just to summarize, we believe you can find a lot of alpha, not believe, we know from our own experience and many of our clients, focusing on unique market events combined with opening areas especially, or unique intraday price action like breaks of 60-minute ranges is a tremendous way to find edges that have stood the test of the time. You can use the 3 C's, causation, context, and confirmation, and the T-test to help you discern between signal and noise and find the best edges. And we're just huge believers in building portfolios and many different strategies to smooth and amplify your returns. And the advent of micro futures is just huge for the ability to do that now. Our average client, I haven't looked at this in months, so I know this is small, but a few months ago when I looked, the number of strategies saved by our clients that they were tracking was over 40 for our average client. And we know some have over 200. So just a great tool for prototyping, saving, tracking, monitoring, building edges, and either trading them manually or prototyping so you can do coding on your own platform for full automation. And we've got tools that we think we've showed you that can hopefully help you. So we'd love to talk to you more about them if interested. I will cover pricing real quickly. Oh, actually, we'll get to questions in just a second. Another good question there from Brad. Discover, we have a couple of different flavors of it, but basically you either have to choose between a monthly or annual subscription. You'll certainly save money buying on an annual. We know a lot of people like to start with a monthly. The most common package we have for the Discover platform is what we call Intraday Pro. That is $2.99 per month. It's a monthly subscription, includes the bias alerts. So that bias library with 150 strategies that Matt showed you, whenever they alert, we had a bunch, for example, triggered today. Whenever they alert, they show up in your alerts tab, and it's just a great idea generator. Even as an automated trader, a lot of our folks would come in, they check the alerts, and say, hey, that's cool, I never thought of that, because a lot of those alerts are contextual. So it's a great way to get ideas, and that you can then, Matt just showed you, save and modify. An annual subscription is $29.90. If you like what you see and you want to get started, we're certainly happy to answer any and all of your questions. And if you sign up by June 30th, you can use the coupon code 50 off or for the monthly, or 500 off on the annual, to save a little bit of money signing up by the end of the month. You can purchase at the link investorquant.com/algo solutions. If you're interested in the SSE database application, that actually has some different configurations and tends to be more of an enterprise type solution. Pricing on that starts about $3,000. So it really depends on number of assets, instruments that you want in the application and the configuration you want. If you're using it, how many users and so on. So we'd love to talk to you about that and answer your questions. You can simply request more information, and whatever your questions are, via the survey that should be in your inbox. Matt, I don't know if you have that. We should have thought of this, but Matt or Brian, if you have the survey link, you can post it here in the room now. That might be helpful for folks as well. Questions? We've definitely gone over here, which we're normally pretty good about not doing that, but it didn't happen today. So Brad asked, after you've mined a strategy, what does it take to automate it? To automate it, Brad, you either need to be able to program yourself and use a platform like TradeStation or Ninja, which are really user-friendly, but you do have to have some coding skills, or an Omni broker or Python. We're a Python shop here. Now, a lot of the bigger firms do that as well, or hire someone to do that for you. There are lots and lots of professional developers out there. I know a lot of people are worried about sharing edges um, with people that develop strategies. And I know I was in your boat a long time ago, and that's why I ended up using a friend. But I can tell you that there's some really good ones out there uh, that will do the work for you. And there's it's work. There's no doubt about it. We do think it's a more efficient way to get a better edge and a better strategy started with a platform, and then look at automating it later. SSE pricing, um, it really depends on what you want edge. So for time's sake, if you can, we'll follow up with you. Just put in your survey, but it starts at 3,000. You're getting access to the whole platform, and it depends again on how many instruments you want to see. And we have some extra buttons that are more commercial grade, if you will, that functionality that might be applicable for some people as well. There's a survey right there. And cost to outside automated depends on the developers. The pricing's all over the map from what I've seen over the years. Brad, you can find some really inexpensive people, but you sort of get what you pay for, like $50 an hour. Others will be 150 plus. We don't do that type of development work, but we can help you with some boundaries. And again, there are lots of solutions if you Google it. There's no shortage. But it's going to depend on the complexity of the strategy as well. And a lot of these strategies and edges that we trade, we keep them pretty simple. I'm a big believer in keeping them simple. So that'll help cut your costs down. Other questions? Again, thank for everyone for their patience tonight. We've definitely gone over by about 10 minutes. Lots to cover.
Scott, John's got a question in here. Before you sign off, are training demo videos available online? Yes, John, we do have training videos available online. Let me just, all my screen sharing's off. I was going to show you. I can show you real quick where they're at. So in our help section,
actually, Matt's done a
fantastic
fantastic
job.
job.
Shows up.
Oh yeah.
Yeah, so this is just, yeah, so in the platform, once you get logged in, this more drop down, we've got a daily support room that I run in the mornings, and I'm available to help you on a daily basis in there. I'm in there about an hour in the mornings, and I'm on the mic, and we can work through whatever it is that you've got questions about. But we also got an extensive video library here as well that kind of goes through the different pieces of the platform, and they're all kind of bite-sized, so you can just learn them quickly on your own and get all the information that you need, but that is all available. Bruce is asking, in your email, you mentioned that micro futures might be helpful for automating trading. Please explain. Yeah, so the micro futures allow you to take a lot more opportunities at the market because they are so much smaller in a tick size than what a normal contract is. So it's less leverage, which means you can have more opportunities to trade without having to risk as much money. Whereas prior to the micros, you had to put a little bit of money into the market, and for some people it was more money than they were willing to risk on a daily basis to be able to trade pretty actively. Whereas now with the micros, you can trade in a much smaller account, but that also means you can trade a handful of strategies on a day, where maybe last year at this time, or just prior, before the micros, which launched about a little over a year ago, you may have only been able to trade one or two strategies in a day. Now with the micros, which are just a tenth of the leverage, then you can trade many more strategies before kind of tapping out your risk for the day. So they give you a great opportunity to be able to trade more actively and do so with less risk. Yeah, and there's going to be, as one of the comments in here says, micro futures options coming this fall. So yeah, I think I saw somewhere around September they're supposed to have those available. Brad asking, how long does it take a skilled programmer on average to detail one trading app? Brad, I wish I was a skilled programmer and I could tell you how long that would take, but I am not.
Yeah, you're looking at hours, Brad, bare minimum, and probably it can really range. It depends on how much you want to refine the strategy and do optimizations on the stops and targets and some of the things that you can't do with our current platform, the way it's configured. Um, it truly is all over the map. But you're probably I don't even, I haven't looked at pricing in so long. I don't know, and it really just depends on the complexity of your strategy you're setting up. Rules-based strategies like we've got here are pretty straightforward, and I wouldn't I think they'd be on the inexpensive side in a relative sense, but again, that's relative as well. Oh, cool. Yeah, please do take the time to complete the survey. It's a great way to help us improve and to give us your feedback and to, most importantly, tell us how to follow up with you specifically and for you to answer specific questions to us. So um, we are about an hour and 15 minutes in, and I think we're going to need to wrap it up. As always, we really appreciate everyone's interest and great questions tonight, great interaction. Um, yeah, there's some recent client feedback. Take a moment. We'll send the slide deck out with the slides, right, Matt?
Yeah, I think you can request that in the survey if that's something you're interested in. So just make sure you fill out that survey, and if you do, we'll be
Awesome.
able
Yeah,
to
we get some tremendous feedback,
get you the slides
as
as
you would
well.
expect. So it is sort of a game changer for a lot of people. So we'd love for it to be a game changer for you and your trading. And if not, tell us what it would take, because that's really what we're really passionate about. We love to trade for ourselves, and we love to help people trade as well. It's a tough game. We've got a tremendous community here with people. Many of our traders have been with us 5 to 10 years. So good to see some of you here, as well as some old names and faces as well tonight. But without further ado, I'm going to wrap it up and call it a night. Thank you all very much. Complete the survey and let us know how we can help you. Take care.